James, I want to key in on something you said about the miners being basically leveraged exposure to the gold price. I know that's Rick something that's something that you've talked about, and you've also talked about the most leveraged are the most marginal at times. It reminds me of an interview that Wilbur Ross did at one point on CNBC. Someone asked him about commodities and how that played into this textile investments, and he was quick to point out that if all I wanted was exposure to commodities, leveraged or not, I wouldn't have to go out and buy a textile company. The same is true with precious metals, isn't it? If you want leveraged exposure to precious metals, you don't have to go out and buy a mining company. So why would you buy a mining company?
Well, I think that's a very good point. I personally, and I don't want to speak for 7 billion people on Earth, nor for two other people as on the call. For me personally, I buy gold as an insurance policy. I buy the physical metal for very different reasons than I buy the stocks. It is precisely true, as James said, that in aggregate, the mining companies provide you leverage to the gold price. They also, ironically, provide you a way to underperform if you don't pick carefully, because there is, if you will, process risk within a mining company. It's important to note that for 40 years, the investment community has asked mining companies to exhibit precisely leverage to gold after the events of the 1970s, when the gold price went from $35 to $850, and the gold stocks outperformed even that fairly markedly. Now, asking companies to exhibit leverage is an interesting challenge, because in one sense, the most marginal companies, if you said, exhibit the best leverage. And we've asked the gold mining companies for the last 40 years to be marginal. And sadly, they've complied.